Sethi, though, joining us at this point, Managing Director and CEO at Chalet Hotels, to talk to us about how it's all playing out within the hospitality space. Mr. Sethi, talking about your Q2 numbers, your overall occupancy has fallen a bit, right? From 74%, near 74% to sub 67%. What does this signal about demand trends across markets, and what are you eyeing in terms of a recovery in Q3 as we head into the wedding season?
Sure. Look, I think the drop in occupancy is actually not an indication of any demand challenges. It's that we added new inventory into our portfolio that you see the occupancy sort of look weaker. On an absolute rooms occupied per day, we've actually grown. Let me sort of capture which rooms we opened. So this quarter, we had additional supply of about 127 or 129 rooms at Bangalore, and we had new 117 rooms at Duke's Retreat. Duke's Retreat had not been relaunched into Ativa yet, which has been done in October. So between these 260 odd rooms, you saw an occupancy, overall occupancy drop. In addition to that, we acquired a resort in Rishikesh called the Westin Himalayas, which is still in ramp-up phase. So that occupancy is ramping up and is today at about 40-odd%, and that sort of drags the overall occupancy down. This was not there last year. Overall, there's no real worry on the demand side. It continues to be very strong. And this coming quarter and the quarter next quarter look very strong on the back of a very strong movement on the corporate travel side, as well as MICE and weddings.
Right. And Sanjay, what drove the substantial top-line jump in the second quarter, and how much of this was really supported by the residential project segment versus core hospitality?
So our combined revenue of just hospitality and office, which are our core businesses, grew by about 20%. This is without residential. With residential, of course, the growth is 90-odd%. So we can ignore residential because that's a one-off initiative and asset that's at play, which will finish, sell, and exit. So let's look at the revenue growth between the two core businesses, which is hospitality and office assets. Office assets are 25% of the total revenue and are trading currently at an exit rate of 23 to 25 crores per month. Hotel or hospitality revenue is the primary revenue, which is 75% of the revenue. And that continues to grow currently in close to double-digit rates. But I think with the combined growth in quarter 3 and quarter 4, we'll see significantly higher growth rates in the hospitality segment too. Going forward, with the addition of the new rooms that we just spoke about, and the fact that some of the assets that we'd acquired in the last 1 year, which will stabilize, we see our total revenue growth on hospitality itself to be in high double digits.
And despite the strong top-line growth, Mr. Sethi, EBITDA margins have contracted. What were the key cost pressures, and how does the company plan to restore margin strength? Give us a sense of that.
So if you look at the overall margin that we have, there was a minor drop in the hospitality side because, as we mentioned, we opened 250, 260 new rooms, and we had a new resort of another 140 rooms. So between these three inventories, which is 400 rooms, there were fixed costs that we had to cover, whereas the revenues are still to ramp up. So once these revenues stabilize, we'll be back to far stronger margins. In fact, we expect overall margins in the year to be stronger than last year.
Right. And what is the anticipated impact of the newly launched premium lifestyle brand, that's Ativa, on financials, and how does it differentiate itself from the existing brands in Chalet's portfolio?
Sure. So we work on three models in the hospitality business. One is the management contract model, where majority of our inventory is under that with the Marriott and the Accor hotels. The second model is the franchise model, where we have 4 points by Sheraton Vashi currently operating in that. We've got a Taj and a Hyatt Regency coming up under that model. And the third model is where we own the asset and operate it ourselves under our own brands. Earlier, they were sort of named independently, differently. We decided to string them together with a common name and in a sense create a brand. And that's what we've done with Ativa. Ativa stands out in 2 or 3 ways. Number one, it's the newest brand in the market. So therefore, we have the ability to start at ground zero and align it with the target customer. audience, which is the millennial and the Gen Zs, and therefore Ativa actually addresses the mindset of millennials and Gen Zs, and therefore is positioned at the upmarket, cool sort of a brand with experiences at its core. If you look at the three pillars of Ativa, they are joy, wellness, and sustainability. All three pillars are critical to Chalet, the way we look at the business, and I think align very strongly with the target audience that we are talking about. And therefore, Ativa stands out with its focused attention to the millennial and the Gen Z mindset.
Okay, and Mr. Sethi, your outlook on commercial real estate, the segment did well in Q2. Can this growth rate sustain in H2?
Yes, it will, because as the office buildings that we have start getting more and more occupied, we're currently at mid-70s occupancy. It'll hit mid-90s in about 6 to 8 months' time. But I think at the exit of March of this financial year, we should hit a run rate of about 30 crores of rental income, which will then continue to grow. So we expect next year to be closer to 400 mark in terms of revenue, and I think almost all of it will flow through to EBITDA. So we expect that to be a strong segment. And going forward, we have another 900,000 square foot under development, which will get ready in the last quarter of FY27 and will then thereafter kick in after we lease it out.
Right. Mr. Sethi, with your RevPAR growing only 5% year on year, how sustainable is your current pricing strength, especially heading into the busy winter and event season? And are you looking at revising prices?
Look, the RevPAR is showing at 5% because occupancy is showed a dip because of new inventory that came into play, right? It isn't actually a fall in the business. Overall average room rates have grown at over around 10%. And we expect that in the quarter 3 and quarter 4 to be much stronger than this, just 10% growth. And we believe that the RevPAR will continue to grow for the coming years comfortably at double-digit numbers, and largely driven by the average room rates.
All right, Mr. Sethi, we leave it at that. Thanks so much for coming in and giving us a perspective. Hospitality, of course, in focus. H1 wasn't ideal for some of those companies. H2, could it lead to a rebound? Well, Mr. Sethi clearly seems positive. But let's go across. We have